Today on the Next, our guest is Hadley Harris, co-founder and general partner at Eniac Ventures, a seed-stage venture capital firm established in 2010. His investment focus includes AI, data and developer tools, software as a service, and healthcare. Now, I was excited for this one because Eniac has been doing a lot in AI even before it was cool, and I've also seen Hadley speaking, writing about the topic quite a bit. They've backed several companies recently that are AI first. In fact, Hadley said that I think it was 13 out of their last 14 companies fit that profile. And so I was dying to dig in on what he's seeing, how he's thinking about it, how his perceptions on the category have changed over time, what they look for, what they're scared about, and where he thinks the future is going. And this episode does not disappoint. We talk a lot in it about Hadley's journey, about Eniac's inception, what led them to get started, and how they've evolved over the years. We talk about venture in general and what's happening at seed stage, what's happening at growth stage, and how the landscape is changing, both from AI, but also from other factors like what's been happening with the public markets and what's been happening with M&A and also an increase in secondaries as a way to get seed investors liquidity in companies that have broken out but remain private and will be for quite some time. And of course, we talk a lot about AI. We talk about Hadley's thoughts on the LLM side and the models. We talk about application specific. We talk about verticals, where Hadley thinks that at the application level there is more defensibility. And we also talk about some of the trends and patterns he's seeing in the strongest teams that are working with these tools, what the implications will be on venture over time, and what the implications will be on bigger picture stuff like the future of labor and quality of life here in America and abroad. At any rate, without further ado, here's Hadley. But before we get started, I'm Jason Jacobs, and this is The Next. It's not really a show, it's more of a learning journey to explore how founders can build ambitious companies while being present for family and not compromising flexibility and control, and also how emerging AI tools can assist with that. Each week, we bring on guests who are at the tip of the spear on redefining how ambitious companies get built. And selfishly, the goal is for this to help me better understand how to do that myself while bringing all of you along for the ride. Not sure where this is going to go, but it's going to be fun. Okay, Hadley Harris, welcome to the show.
Thanks, Jason. Happy to be here.
Yeah, thanks for making the time. And we were talking a little bit before I hit record, but I mean, wait, is it Eniac? That's how you say it?
Eniac, or yeah, Eniac. I usually say Eniac. Some people say Eniac.
So I've known Nihal a long time, and I've known a number of your portfolio founders, and I'm sure we have a ton of connections in the New York and just broader startup ecosystem as well. But the reason I reached out to you and asked you to come on the show is you did a tweet back in February, and it was something to the effect of 2021 was about growing really fast at all costs, and 2025 is about growing really fast at low costs. And I looked into it a little bit, and you've been thinking about and investing in and active in AI stuff for longer than the tire kickers. And yeah, so I thought it'd be a really interesting discussion and that you would have a perspective that I could learn from, which is what the show is all about.
Yeah, I'll do my best. Sounds great.
Great. For starters, maybe just give an overview for anyone that's not familiar of Eniac and what you do.
Sure. Yeah. So we're a seed stage venture capital firm. I co-founded the firm about 15 years ago. My partners and co-founders go way back. We all studied engineering at Penn together way back in the late 90s. And then coincidentally all had somewhat similar paths, came out of school, worked as developers for a while, and then starting and helping grow a bunch of venture-backed businesses. The first one that I was involved with is called Glingo. And to your point about AI, this is a very early AI company, started in 2007. I got connected with the founders. It was an MIT spin out, and they'd figured out a new way to do voice recognition. So it became the first voice-based assistant. This is pre-Siri. Actually, eventually we were acquired and got folded in and it became Siri. So I wasn't at that point building AI was extremely difficult and you weren't using off the shelf APIs and models and whatnot. So I can't take any credit for the tech. I mostly ran a lot of the business aspects. But that got me excited about the potential of AI. And this is a time when people were barely using the term AI. In some ways, it was considered a dirty word. But a lot of my career since then, especially from an investment point of view at Eniac, has been focused on AI companies. Again, before it was cool. Obviously, the last couple of years have been very different.
And so you started your professional career around the time that I did, which was late 90s, right in the cusp of the dot-com boom. When I look backwards from 2025, it feels like it was the internet, and then it was mobile, and then it was the cloud, and now it feels like AI is the next kind of big sea change. I just want to stop there. Is that how you think about it as well, or something different?
Yeah, very much. Yeah, I entered the workforce in '99 as a developer, and that was the height of the dot-com boom. Obviously, that kind of crashed and then came back. I see that the way you described it. I would say, in my opinion, the internet and AI are a higher order of magnitude. Mobile and cloud, a little less. They were very important. When we first started Eniac, actually, our singular thesis was that mobile was the next kind of evolution of computing. So we only focused on, for those first few years, on mobile-first companies, and that changed over time as that no longer made sense. But yeah, I agree. Although I do think we're entering a time that will be as, if not maybe more impactful on the world than the internet was.
And I've heard you talk on other shows, and it sounds like at the earliest stages when you guys come in, it is less about the business since there's not as much to judge, and it's more about the founders. I guess my question is, when you think about these sea changes, can you look at history to guide how to adjust as we enter a next sea change? Or is it similar to the quote, if you've met one family office, you've met one family office? Like, if you've met one sea change, you've met one sea change? Or is there actually learnings from the prior ones that could inform how to proceed heading into this one?
Yeah, no, that's a great question. I think, like you, having been through these other sea changes, I think there are lessons to be learned there. But then, so it's in the middle, right? But there's differences in how they all play out, I think will be quite different. I do think it's helpful. I think even just thinking about kind of the timing of when the best companies will be started, like I do think we're right now in a golden age of company formation where we're 2 years in, certainly some important companies have been created, but at the very beginning, usually a lot of stuff gets thrown against the wall that doesn't stick. And then people start to understand more of what this kind of wave will look like, and then they may be in a better situation, to stay with that analogy of surfing that wave. So I think there's probably some lessons to be learned from the past around timing, and there's probably some other areas, but you have to be careful of these things because every situation is different. These technologies are very different. The industries and the way that they'll affect society and business, I think, will be different.
I guess this is an Eniac question, but also a Hadley specific question, since different partners might have different philosophies. But do you have a philosophy in terms of how you like to time the paddling, in terms of who you back when the wave is coming? And what I mean is that, like you said, sometimes there's this first wave of people that are really feeling their way in the dark, right? And then there's throwing stuff against the wall because there's no point of reference for how to think about it. And then there's learning, and then the second wave of fast followers can sometimes learn the hard lessons that off of someone else's peril and come in a lot more pragmatically with more of a game plan. Do you sit out and watch for a while, or do you like to be in that first wave?
Yeah, no, it's a great question. I think our general approach here is that it's hard to time these things and to focus on the best founders, and that the best founders will figure out how to ride the wave. So while my gut is that we're in somewhat of a peak time now, we're not banking on that. I think that can be a hard thing to bank on timing. So we tend to invest at a relatively consistent pace over time. We've done something like 14, 15, or give or take a few investments for the last 10 years. That way you don't have to be susceptible to market timing. I think what a lot of investors do is during kind of hot times, that's when they deploy their capital, and then things freeze up and then they deploy less. So if you actually do that, you're going to pay higher buying prices over time. So I'd say the 2 years leading up to this were quite cold. A lot of investors had deployed very quickly in 2021, whether that was crypto or other things driven by interest rates. Then they didn't have any capital. So that was like a great time for us. We saw very little competition, like companies raising wouldn't move that fast. And that was because we specifically didn't go too fast in 2021. Now we're back to hot times. While my gut is that this is a really great time for company formation, and we're seeing more great opportunities this quarter actually than ever before. Maybe we are deploying like a little faster. We will try and be somewhat consistent over time.
And just generally as a firm, are there do's or not do's in terms of, can you go anywhere, or do you stay away from certain categories or certain business models or deep tech or things like that? What are the guardrails, if any?
Yeah, I don't think there's any kind of official guardrails, but we tend to be software focused. We have done some kind of hardware, software kind of full stack type stuff over the years. It hasn't been the best category for us. I think we generally but are kind of tech and software oriented. So one thing we don't do, just to make it more simple of what we don't do like brand oriented sneaker companies or whatever that for a while was actually a very popular thing for VCs to invest, especially in New York. And to be honest, I never got it, and I'm wrong quite a bit, but this one, I think I was right. There really was like a lot of value destroyed investing in those types of companies. They're just not venture-backed companies. When your only mode is brand, I think it's difficult to be a venture-backed business. So generally tech, software oriented, and these days, like mass majority, I would say maybe 13 out of 14 investments we did last year, I'd consider an AI first company. It's just, while it's crowded, it's also just so natural that there's this why now. There's all these use cases and problems being solved that never could be solved before. And that's just generally a good place to invest versus something that has going into a very crowded space.
So you just touched a little bit on the question that I was planning to go to next, which is that you talked about how if you look at the cloud and mobile, for example, those are both huge, but you actually think AI is going to be bigger, right? As big as the internet. When did you come to that conclusion? What were the data points that led you to that conclusion? And then what do you think the implications will be looking forwards? Gosh, that's almost an impossible question to answer.
That's a lot.
It's too big.
A lot. Yeah. If you look at mobile, it was mostly a consumer. A lot of the value is built within consumer. There's obviously some like enterprise mobile stuff, but I don't think there was that much there. And obviously there are companies like Uber and Instagram that got built, and that was important. And then if you look at cloud, it was more the opposite. Like a lot of the value got built. Obviously the hyperscalers built these like cloud businesses, and that was really important. End users, I don't think it was touched them that much. Like it's been abstracted away from end users. I think that AI will have a big impact on both of those things. We're mostly seeing B2B. I think consumer will be really interesting. I think we finally have kind of a shift that will be, since mobile, I don't think we've had a shift that will allow big new consumer companies. And you're starting to see that with Perplexity, obviously OpenAI itself. But I think there'll be a lot more. And then I think its impact on businesses will be quite a bit bigger than cloud, because it actually affects, it's not just software, it affects labor. And I think what you're going to see is that a lot of labor is going to get disrupted by AI in a way that cloud and mobile and the internet, for that matter, never did. And that's going to be really incredible for businesses who can run their businesses more effectively. I think it will come with a lot of kind of societal disruption that I think we as a society need to be ready for, because I do think that for centuries, people have been saying that technology won't affect labor and that people adjust. I think the rate of change here and the effective change will be too much for society to keep up with, but we'll see.
That's one of the things I'm worried about. If I'm only a few months into really looking into AI in earnest, and what I've seen so far is that it is easy for me to see and grok SaaS will be under pressure, for example, or how companies that were really human intensive for very mundane operational stuff like that, it's easy for me to see how value will be destroyed. It is also easy for me to see how short-term unsustainable value will be created by new players. It is harder for me to see how durable new businesses get built. And I'd love for you to just talk a bit about how, because you're in the business of value creation, not value destruction. And so just how you see durable value getting created with AI.
Yeah. I think within B2B businesses, there'll be a lot of durable value. I think a lot of the durable value in what I'd call more horizontal, just general information worker type stuff will probably be eaten up by a few very large companies. Probably, we'll see, but I think that's where your OpenAIs and your Microsofts, Anthropic and whatnot build a lot of products that will eat a lot of value there.
Is that oligopoly already set in your mind at the LLM level?
I doubt it. I think people generally underestimate the change that happens. So I also wouldn't be surprised if some player we haven't heard of. I meet a lot of founders. I don't do as much kind of foundation model investing just because we're relatively small and those things are very expensive. But yeah, I've been meeting founders that are taking brand new approaches that who knows if it works. Could be, I think what you saw with DeepSeek is interesting. No one saw that coming. A lot of smart people thought you couldn't do that shit. It's pretty cool. But yeah, so back to your question, I do think there'll be some set of oligopoly that will attack that between the newer model companies and someone like Microsoft that just has this crazy advantage of already having distribution. Where I think you see the other area where I think startups will mostly impact is going to be more in vertical solutions. So a lot of the investments we're looking at, especially at the application layer where we're spending most of our time now, is within certain verticals. I think like healthcare, financial services are two examples of this, where I think it's less likely that those companies, there's a lot of nuances to those industries around kind of privacy, workflows that are relatively specific. And then those are like the big industries. There's tons of these very small industries that either have very old school vertical SaaS solutions that they're using, or maybe you could never have one. I think if you look at like legal and like consulting and these types of areas, they were all very human intensive, and you can actually build software that kind of solves these problems because of these models' ability to understand and communicate in an unstructured way. To your point, you have to think about, okay, what is the long-term moat? Because the AI itself is unlikely to be a long-term moat. A lot of these founders may try and point to some proprietary data sets, and in some cases, maybe that's true, but I think that's a hard thing to build your company on. I think more likely what we're generally looking for is there's some like second act that is not necessarily reliant on AI that can become that long-term moat. You may see that as becoming the new system of record that takes over. There may or may not be an existing system record. Another example is building some sort of marketplace, so like a two-sided marketplace, whether that's B2B or B2C. Marketplaces tend to be great kind of moats if you can build both sides of the marketplace. So that's at least how we're thinking about it.
Is it too early to have role models to look to that have made that transition?
Probably. We are just so early. Like, I think especially for this type of company, these like vertical AI first companies, we're still, the ones that are doing best were probably formed like 2 years ago. It's interesting, like companies that were started too long ago, we're seeing have trouble adapting. They've just been structurally and from just a vision perspective, not built for this environment, and they're tending to struggle. And there's kind of these new entrants that kind of come up. I know you talk a lot on the show about utilizing AI to build the company. Like they're AI first, and they're just like very agile and grow quickly. They build a lot with a small team. Small teams tend to be better at innovating and moving fast. Yeah, I think it's going to be these younger companies that are like probably founded in the last couple of years or even being founded now that are going to be the most successful.
I hadn't thought of this analogy before, but I grew up in my early years professionally. We're spent in data storage startups, and so we did a lot of work with the hosting providers, the Exoduses and Global Centers, and most of the people on the show are going to have no idea what we're talking about. But you remember, because we're both fogies. Yeah.
We had a data center in downtown Boston. We had to go like visit every once in a while, and someone had to move the wires around.
But the reason I bring it up is that in 2000 or 2001. When the bottom started falling out and all the .com shakeout started happening, if you walked down the rows of rack after rack in these hosting facilities, their customers were all the .coms. And so they were very affected when all these .coms went out of business because those were their customers. So then the hosting providers suffered. And the analogy that I wanted to draw and get your reaction on is the tire kickers with AI that are propping up the revenue of some of these companies in the short term because they're like, oh, I'm flat-footed and I need to do something and there's so many tools and I don't know which tools, so let me go just subscribe to all of them. Yeah, and I'm like that, right? Like I'm a little fish because it's just me personally, but it's like I have all these different tools and I don't know which ones are going to become my go-tos. I don't know how much I'm going to leverage them ongoing, but out of the 10 or 12 subscriptions I probably have, I'm probably going to end up with 2 or 3 when all said and done. Do you worry that about, if you look at Cursor as an example, do you think that's durable or do you think there's a big kind of tire kicker premium that's not sustainable?
So yeah, this is something we talk about a lot. I think it's interesting. You see this play out when you try and look at the churn rate of some of these really fast growing companies. They tend to have very high churn rates. And a lot of it is what you're describing is a lot of tire kickers, a lot of folks trying 5 things in parallel. I'm not as worried about that at the overall usage level or like the size of the overall market, because think about it this way. If you're you're trying 5 different AI first sales tools, eventually you're going to pick one of them and then that's going to get deployed. A lot of these like proof of concepts or pilots are done on like a small set of the company, and then the functionality of all these companies is evolving very quickly, so that will get a lot deeper. While 4 of the 5 will not make it, that one will be like the use of that one will probably be far greater than it is of the 4 or 5 now. But yeah, it's an interesting dynamic we're definitely seeing, and I think especially when you see these announcements, someone went from 1 to 10 or 2 to 20 million ARR. We've done some research just to understand these companies. Their churn rates are ridiculously high. So it almost has to be expected.
And you talk about, in this discussion, you've been talking about the criteria that would make for more defensibility beyond just brand in an AI world. And you talked about the second act and the marketplaces or things like that. In a prior podcast episode that I listened to that you were on, you talked about some of the learnings in the early days of Eniac, and one of the learnings was that base hits and doubles aren't going to get you there. It's a power law game. One thing that I'm chewing on that I wanted to put out there for your reaction is that in a world where it is harder to come by these moats and you can achieve some defensibility but not as durably as the past, maybe that means that the life cycles of these companies play out faster and that the outcomes are more modest, meaning that venture starts gravitating, or at least some portion of venture starts gravitating towards a world where base hits and doubles are the game and on base percentage is the game, and it's not power law any longer. And I wanted to just put that out there for
That's
your
a great question.
reaction.
I'm skeptical that would work. The one thing that you said that I think is important, and I do agree with, is that the timelines I think will get compressed. So I think things will turn over much quicker. So that has the ability to change the whole dynamics of venture in terms of it just being more attractive. I'm still skeptical about the being able to double your way to success. I think even if there are less winners as a percentage wise, because more companies are getting funded, I still think it will until I see the power law not hold, which it never has in my knowledge in venture, I'm going to keep believing in it. So I still think there'll be these gigantic outcomes that as a power law will be such a big percentage of all the outcomes. How that might change how you invest I could imagine, this isn't something we've executed, but I could imagine if the dynamic starts playing out, you may want to make more investments, because I do think the biggest companies will be bigger because of what we talked about with it eating up value within labor. But the percentage of winners may actually be lower than the past because there's more companies getting funded. There's more founders wanting to jump in and smart people start companies. So you could imagine wanting to take a broader approach that you're more likely to have these big outcomes.
Do you think that the emergence of these tools changed the calculus at all as a founder in terms of when to go the hyperscale route versus when to bootstrap? And I know those are barbells and there's a lot in between, right? Yeah. But just if you were starting a company, would it change the calculus for you?
I think it would. I think So I haven't really seen this play out, but I think what is going to likely happen is you're going to see more companies bootstrapping or raising very small amounts of money that they need, and then maybe not raising money after that. So I think I could see a world in a few years where a lot of companies only raise seed rounds and they never raise Series A's. And if I'm like Andreessen Horowitz and some of these very big multi-stages, that's what I would be scared of. And it's one of the reasons we think staying small and staying early is a good place to be. I haven't really seen that play out right now. I think there is a bit of a gold rush going on right now, where I think companies have a sense that they want to raise from just to be offensive. Maybe a lot of that money goes into more go-to-market than it does into development, just given how efficient some of these engineering teams can be. I think there's also this weird king-making dynamic going on now where there's a bunch of companies. I think you saw this, like legal is a good example. Jump in and there's these AI for legal. Harvey's wants to raise all this big money from certain investors to present itself as the king. I don't know that space that well. Are they the best product? Possibly, probably not. But that does create a little bit of a dynamic where when you're a big law firm, you're like, let's try the different products. And as you say, let's run proof of concepts. But if they tie, I'm probably going to invest in the one that like Andreessen put 100 million in because they're more likely to make it. You know what I mean? So there is this weird like king-making thing going on that I think is detached from the actual money that these founders need, which is, I think in long term, that's probably not a good thing. It's probably going to cause a lot of problems, but it is a weird dynamics going on that it goes against what we were just talking about in terms of just needing less money.
Yeah, and if there's a fight to get in, then maybe there's big secondary, and if there's big secondary, then the founders their incentive to care about what happens on the other side of that maybe isn't as high.
Yeah, that's true. Although I generally am in favor of founders taking secondary just because I think it makes it more likely that they'll go big versus when your partner's bitching at you, you can make a lot more money at Google and you could sell for 100 million, which is an amazing outcome for a founder. Us as investors, that's not that great. We want to incentivize them to go for that huge outcome. So I do think secondaries are more aligned with us in terms of, or help align us with the founders.
One clarifying question, how do you think about reserves and follow-on? And do you have any type of opportunity vehicle within the fund to go deeper in your breakout companies?
Yep. That's a great question. We're about 50-50 in between kind of initial and follow-on. So we're investing out of our sixth seed fund, which just started investing a little under a year ago. So yeah, about half of that will be the initial investments. And then we'll generally invest in Series A's and maybe some B's out of that, and then we do have a small opportunity fund that we can invest in later stage rounds as well.
Got it. And you mentioned that something like 13 of 14 companies that you have backed recently are AI first. How do you define AI first? What does that mean to you?
That's a great question, and I haven't really thought about this, so I'll just kind of wing it. I think one is the kind of core product would not be possible without AI. And by AI, like recent kind of transistor-based LLMs or similar type models. And probably the other thing I'd add to that's probably the main thing. The other thing is that probably the problem they're solving was not previously solvable. I would think if I look back, at least the last couple of years, probably all the ones that I think of as AI first probably fit that.
And softball question to pimp the portfolio, are there any examples that you want to bring up that kind of illustrate those two criteria?
Sure. Let's see who gets it some love. We have a company that we invested in before ChatGPT came out called Attention. That's a leading generative AI-based sales tool. So it listens to and understands all your sales conversations and then has agents that will do things on your behalf afterwards, like following up or alerting the sales manager to certain things that are going on. I put that in the bucket of we're very lucky that we were investing in some of this stuff before ChatGPT came out. And then when that came out, it was like this huge rush and every investor was investing in this stuff. And it definitely got more crowded. And then more on the infra level, invested in a similar time a few years ago. True Foundry is a company that's infrastructure for enterprises to be able to deploy and maintain open source models, open source LLMs on their own infrastructure. So think about large banks and healthcare companies. They don't want to be hitting OpenAI with that privacy mindset. They want to deploy models like a Llama or something on their own infra. there's a lot of technical complexity to that, and making it efficient. True Foundry system allows you to manage all that in a very efficient way.
I want to go back to something you said before, Hadley. You talked about how you earlier in Eniac's life cycle, you were mobile only when you were starting out, and at some point that didn't make sense anymore. You could almost argue, and I know it's not exclusive, but you're almost AI only now. And so I'd love to understand why it didn't make sense anymore with mobile and what it would take for it to not make any sense anymore with AI, because mobile's obviously still a thing, right? It's like in everything, right? And AI is similar. It's not an industry, it's everything, right? And yeah, so I just want to pull on that.
That's a great question. So I think you'll actually probably see something similar play out. It's probably helpful to say we were mobile only partially for branding purposes because we were a new fund. We were our first fund was 1.6 million. So we're a tiny fund, hard to get noticed. There weren't any mobile focused funds. It's hard to remember, but like 2010, mobile was this thing that it was like almost like AR, VR now. It kept being promises, but it never came through. I can find you some Fred Wilson tweets where he was like saying how mobile is like never going to be a thing. It's like it's not happening. It was very bearish. Obviously, a great investor. So it was partially that, and we were all building these mobile first companies. So it was a natural fit. At a certain point, I think it was around 2014 or so, it just became artificial. And it's like, what exactly is a mobile company? Every company has some mobile aspect. And I think that's even more true with AI, because mobile, like we talked about before, didn't really touch a lot of like enterprise the same way as AI or a cloud did. I think you could already argue that AI is everything's AI. It's like back to like we're talking about the internet. At one point, there was like an internet team at VC who was doing internet, and I'm not sure what the rest of those people were doing. And then it's like, okay, well, everything touches the internet, right? Like how is it not internet? And probably before that, there was like a software team, and I don't know, these other guys, maybe semiconductors or something like that. I think AI is like that, where everything will obviously utilize AI, and then you just won't call it. We won't be like, we have an AI focus or AI thesis. It's just hopefully there'll be something within that maybe you focus on.
So does that mean one day if you're not AI first, then will everything that survives and thrives be AI first?
By the definition that I said before, probably not. Like I think what you'll find is there's companies that will use a lot of AI, certainly within their development. I don't think anyone's going to have a engineering team that's not heavily using AI. That just wouldn't make sense given how good LLMs are at writing code. I'll give you an example. We have a portfolio company that we backed originally probably 4 years ago called Ghost. It's a B2B marketplace for excess inventory. So anytime like a retailer has excess stuff, right now they can sell it to like TJX, which is TJ Maxx, and Marshalls are trying to move it in other ways. This is like a real B2B marketplace that's done that. They're crushing it. Fastest growing company that we've invested probably in the last 5 years. Funny, it's really not AI first at all. And it could definitely exist without AI. So the why now was different. It was more of an insight that the founders had. But if you looked at their engineering team, because I was talking to the founders recently, like they're using all these tools. They're trying out all these tools. So like it is an AI company in what they're using, but it's not an AI why now and an AI use case per se. So by that definition, I think there will be non-AI companies that will be successful.
I'm trying to find in my notes the two criteria. Refresh me again. So one was that the problem.
Well, I made it up at the time, so it's not a long thing.
Yeah, but the problem couldn't be solved.
The core product is utilizing AI, kind of an important part of it. It's not just an add-on, and that the problem couldn't be solved without kind of these newer types of AI.
Yeah. So what I didn't hear mentioned is how building gets done internally. Do you find that the more companies lean into AI with their products externally, that it does manage to the index of the more they are externally, the more they build with it internally, or is there a wide range?
Yeah, it's probably hard to say because so many of the newer companies are utilizing AI in their products that there's not like a big data set of like non-AI companies like I could look at. In general, I feel like that's probably true because they're just more knowledgeable and they see the power of AI. So of course, why not utilize that as your team? I see a correlation between success and how heavily they use AI internally. and that kind of mindset. They definitely are moving faster. There's a huge advantage to being able to create. Not only can you create product quicker, you can create product with a smaller set of people. And smaller sets of people are much more efficient, and they're much better at finding product market fit and iterating. So that's like a huge power, especially in the early days. So I think, and the reason I don't include that, to your point, your question about in the definition, is I think that's just table stakes now. Like, you can't be building a software company going forward without utilizing these tools. They're too helpful.
I've had some companies on the show that where the technical team is technical and they get leverage from the tools, but the non-technical people stay in their lanes and do non-technical things. And I have other companies, like one company, 4 co-founders, and one of them's technical, but all 4 of them are writing code every day. Do you have any point of view in terms of a successful recipe, or one you have more conviction in, or is it just team dependent and any different combination can work?
If I understand your question correctly, I think everyone at the company should be using AI. I think there's very few jobs, even for this podcast, I imagine you're using AI. Like I, as a VC, we have tons of tools. We're constantly iterating with new stuff. I think AI is going to really change VC. So I think everyone, technical and non-technical, I have seen that case as well, where the technical team's using Cursor or Copilot. What are those marketing people doing? Like I told you about attention, like their impact on sales teams is incredible. So like everyone should be using the latest stuff, or at least experimenting and understanding how it can help them. So that, I say, part of what you may have been asking is, should the non-technical people be involved with the test, with like coding, for example?
Yeah. In other words, like AI can help people with expertise to have more leverage, or it can help people without expertise to act as if. And I guess my question is, when you're building an industrial strength company, is it only for leverage and the experts should be experts, or do you think the non-experts should be pushed to act as if?
Yeah, that's a great question as well. I'm not sure. I think I've seen both, so I'm not sure which is the better one. I think the question that this makes me think of, which is something I think is worth a lot of people thinking about, and there's like very smart people on both sides of this, is like, within, say, engineering, what does the future look like? Is it going to be like one senior person and a bunch of agents, or is it going to be a bunch of more junior people utilizing agents? And I've talked to a lot of people much smarter than me that kind of built engineering teams that are on both sides of this. My gut is it's more the first one, which is smart people at the top, and then you have a lot of agents doing more of the junior work, and that there won't be as much work for junior people. But it's related to your question.
And I mean, I asked this on LinkedIn a few weeks ago because I've been hearing that debate, both sides of it. If there are less junior people, then what becomes the path to becoming senior? Yeah.
It will be an interesting world. I don't know. I'm guessing you might have there's so many more junior people than senior people. So right now you have this natural funnel, right? Hopefully that funnel remains, and it's just who are the junior people that can break out and become those senior people. It's also a question of like time horizons. If that's a situation for 50 years, that's a real problem, because you're going to run out of senior people. My guess is by the time that long time goes by, that dynamic changes again. I don't know, maybe you have AGI and the world just looks so crazy that kind of one-to-many relationship doesn't stand.
And I guess this last topic area is more like, I guess it's less with your Eniac hat on, although it's related to Eniac, but it's more like Hadley, the person who's of a similar age to me. One of the things that I find that I wrestle with is that you're a VC, you have limited partners that trust you with their capital. Maybe their capital is coming from people's retirement funds or things like that, where it's like,
in our cases, it's mostly that kind of thing, yeah.
Yeah, and like you have a fiduciary responsibility to drive the best returns that you can. If you look at the implications of the companies that you back, one of the implications might be, if they're wildly successful, that it kills a lot of jobs. And I guess my question is, if you aren't an impact fund or a social fund with a label on it, right, but you just try to be a good human that lives a good life, right, how do you manage that fiduciary responsibility with trying to do right in the world? And is it a responsibility of people in your seat, or in any seat as fiduciaries, to also think about those second and third order effects, or is it just someone else's problem?
Yeah, that's a tough one. I generally believe, and this kind of goes back to my beliefs around AI in the future. I tend to be an optimist in general, and I am a kind of AI maximist slash like. I think the end result will be very positive for humanity. I think we're heading into an incredible time for humanity. I think AI is going to solve a ton of problems. If you just look at like drug discovery and things like that, I think it's going to be incredible. I do believe, and the time horizon is tough to say, we'll get in a situation where people won't really have to work. And I think there'll be a situation of mass abundance. The question is how society gets there and aligns itself, because that could go real. I think there's an opportunity to be really great. There's an opportunity for a lot of shit to go down. And yeah, I think a lot of leaders around the world are not prepared for that in any way. And it's a bit of a scary situation, but I do believe there's the opportunity to do that. And I do think a lot of the stuff we're investing in, maybe a little less us because a lot of it's driven by the kind of foundational layer, are going to drive that over time. So there's going to be disruption caused. There's going to be bad things. The internet has caused a lot of problems. It's also allowed people to get closer and a lot of good things. So I think and I do think it's up to probably things that are outside of my control of whether that works or not. It's more societal. It's more around governments and kind of leadership, which at least at this point in my career, I'm not really involved with. But I think the end result will be positive.
Yeah, and that wasn't a question it wasn't a leading question to suggest that you should be it, because division of labor is if you try to do everything, you'll do nothing. Everyone, to some extent, you need to stay in your lane. You need to drive. You have a fiduciary responsibility to do. And if the government does its job, right, then because I worry about that. I worry because mass abundance is only mass abundance if it's evenly distributed. Yeah, because otherwise, if it's all accruing at the top, then like what happens to the rest of the people, and how do they put food on the table if they're not being provided for and they have no means to provide for themselves?
100%.
Yeah. But that's above our pay grade, though. That's not what we're paid to do. So.
To be, for what it's worth, we don't invest in just more out of morals and things that we think are going to like directly harm society. I looked at a company recently that I thought might be an okay investment, but I really thought it was bad for society. It had to do with kind of healthcare and how people got information around healthcare. And it just didn't feel right to me. Certainly, we are trying to make money, and for our investors, almost all of our investors are nonprofits of one way or some sort or another, and that's something it's really important to us. But you also don't want to be like directly harming and investing in Juul or whatever, a company that's I think directly harming people.
And I know that no one has a crystal ball, and I'm no expert on the venture business, but it seems that that liquidity needs to come in order to drive returns, and that liquidity can come from the public markets or from M&A. Obviously, the last few years, it's been difficult to come by either of those things. As this revolution plays out and accelerates, do you think that side of the business in terms of how liquidity will be generated will change? And if so, how?
Yeah, it's actually changed a lot in the last 4 years or so. And I think it's not as broadly known, but yeah, we've done a bunch of secondaries either directly in our companies or at the whole fund level. I think we've returned 3 or 4 funds worth over the last 4 years without any exit, without any IPOs or M&A, because
what's the profile of the buyers in those scenarios?
For they usually are follow-on investors for the direct ones, especially like 2021. There was a lot of like very high priced rounds where we sold to the new investors, and as seed investors, like generally no one cares. If you're Sequoia who led the A and B and then you sell, people that can raise some eyebrows. So it's a real advantage of being a seed investor. And then you're seeing a lot, right? And that's even, I think, in the last year, more and more secondary investors, specific secondary funds are trying to get into these kind of private companies because they're staying private so long. Funds that want to buy out like a portion of your fund. We have older funds that have done well that we want to liquidate to get money back to those LPs, and they have companies that people want access to. So I think you're going to see a lot more of that. I think not reliant on M&A, especially coming from the very early stages where you can have We tend not to sell unless a company is worth a whole fund, kind of going back to the power law. But you tend to have these companies that can be worth a fund or two. And I think it's good for everyone to sell part of that, get cash back to our LPs. That's our job. So I think that dynamic will continue.
Does that tend to happen when rounds are coming together anyways?
Traditionally, yes, but I think more and more it's even happening outside of that. And it's even happening at the fund level where it's, okay, we'll buy 20% of the entire fund across the whole portfolio.
Is there equivalent of like the way that that a startup where it might be their time will engage with a banker to run a process is the equivalent for a VC who's looking to drive returns through secondaries?
Maybe, but I haven't seen it. It's a relatively small community. A bunch of our LPs are getting into this as well. So I would say over the last year and a half, we did a secondary sale last year that a lot of folks inbounded us. So yeah, I think it's going to become a thing, and I'm seeing more and more of it. And it makes sense, like back to your, people should focus on what they do. We're early investors. We're not like investors should be deciding on some company with $1 billion revenue of whether to hold or sell very late. I think we want to do what we do best. And we want to get money back to our LPs.
Hadley, for any of the founders listening to the show, what has you excited? Is there, if someone's working on X, get in touch, or who do you want to hear from?
Sure. Yeah. Any talented founder. I think a lot of our time is on what I talked about, these kind of vertical AI first solutions, especially have a long-term vision to put that second act. But I'm also spending time, we haven't done much in consumer for a while, but I do feel like now is the time to build an AI first consumer company, and ended up making 2 investments last year that were consumer. They were founder first and folks that I had either worked with before or just was really impressed by the team. But yeah, that open to that as well. So yeah, I'm easy to find on Twitter, X, whatever you want to call it, just at Hadley, and LinkedIn, just Hadley Harris. Yeah, easy to find me.
Anything I didn't ask that you wish I did, or any parting words?
No, I alluded to this. I think we're entering just the most exciting time for startups that I've ever seen. And I've been doing this for a little while. So I think if you're considering starting something, but you need a little bit of a nudge, like I'd say do it. There's never going to be a better time. I think there's a good chance that we're at a pretty unique point in history to start something new. Just do it.
A quick time check. Do I have a few minutes to give you a recorded idea to get some feedback on to include in the episode?
Sure. Yeah.
Okay. One of the areas I've been looking at it, as I was the Runkeeper founder and CEO, and I pretty traumatized after pushing that boulder up a mountain for almost a decade. Landed the plane, had a good outcome, had enough time away that I forget how much it sucked. And fitness and sports is just such a big part of my life. It's a big part of my life as a participant. It's a big part of my life now as a dad with my kids stuff. And so I've just been paying a lot of attention to it without any professional hat on. But then I can't help but notice that AI is making a lot of new things possible as it relates to, for example, my son has a former player who played the game at a very high level, who coaches a U18 team that's very high level, and then on the side just works with some kids. And one of the ways he works with kids is he pulls clips from their last game. He does a little write-up, walks through the game with them, areas they can improve, things they did well, etc. Has hundreds of these write-ups across dozens of clients. And so if you took those and you trained a model, could get AI to do what he does. So that's one idea. Another idea is, there's AI tools popping up for pickleball, for golf, for fencing, for dancing, for figure skating, right? And so I bet if you stood up this infrastructure in a lab-like setting and you just had a sports focus, you could probably find some categories over time where you could take advantage of this stuff, computer vision, machine learning, et cetera, and you could build a portfolio of these sports where you get into a rhythm of a subject matter expert in each area, but then a lot of the infrastructure and team under the hood could carry over from sport to sport. And don't build 1 million of them, but pick a few, do them really well, build a beloved brand with a cult following, and make a nice living with or without investment, preferably without to start, but maybe investment down the road if once it's proven out and baked and you're ready to scale. And to your point, the second and third acts, like you could, in the hockey example, you could start acquiring or building mini rinks and put cameras in them and be really tech forward and use AI for scheduling and for analysis. And right. And so there's a lot of things you could do directionally beyond this entry point, but that's the entry point that I'm considering. Anyways, love your thoughts.
Yeah, I think it's interesting. Would it be mostly, is the kind of connected thing there coaching or giving athletes or aspiring athletes feedback and helping them be better? Or because there's also kind of like a highlights aspect to this. Nahal and I always talk about, we play tennis, like, oh man, I wish we had the highlights from today because we actually did something good for once.
Yeah, I don't know yet. There are companies that are doing all of those things, but like one, and then there's another question of who you're targeting. Are you targeting the serious competitive people, the teams and coaches and elite or universities or youth sports clubs, or are you even just targeting like the casual enthusiast? And with Runkeeper, for example, we tried to thread the needle between, it's like the people that were serious enough that they wanted something, but not serious enough to get the $300 dedicated device. And if you take the golf example, Topgolf is a good example because is Topgolf entertainment or is it golf instruction? It's like you practice, you use your real clubs, you get better at golf, but there's this whole rich experience around it that attracts a lot of people that aren't serious golfers. And and that's my, and I haven't done a deep dive, but what I'm seeing in the coaching and analysis world is that there's a lot of noise, but like a lot of it's crappy, like side project, or it's catered to the enthusiast where it's like the kind of people that would keep a spreadsheet anyways, even without any type of tool, or there's like humans in a marketplace, but it costs $100 or $200 a lesson kind of thing. And it's, could you open up that market if you made it a much more affordable price point and wrapped a rich experience around it with some community, some competition, some game mechanics? You made it really fun, almost like a virtual Topgolf style.
Yeah. I think there's something there. The part to figure out where there may be friction is just around like the interactions and capturing the data. I don't know, you probably use your phone, but like getting the right interactions to do that. But like at a high level, when I think of consumer, just starting to think about this for the first time in a while, there's a lot of stuff. It's things that rich people do that you can now expose to the rest of the world. Uber is like a classic example of this. I think rich people generally hire like personal coaches for their kids, and shouldn't everyone have that ability? And it could just be $9.99 a month instead of ungodly amount I imagine it is to get a great coach. And it could be trained based on, you could have the personalities of Messi or something helping you with soccer. You could have royalties around his likeness or whatever. So yeah, it feels like there's something there.
Yeah, and by the way, it's not a pitch because I haven't narrowed it down at all. The only point I've gotten to is, okay, you know what? Just take this market like with a wide lens, and let me take a few weeks and put some blinders on and just go and just dig into it. And so actually a bunch of the people that are innovating in this area I'm going to have on the show, and I'm being very clear that I'm considering doing something there. I'm not like trying to hide anything.
Given your background, there's a great founder market fit. So yeah, keep me in the loop.
That's the biggest thing that it's like, is it fit? Because I heard some people say, I just don't think anything in that category is going to be venture scale. I'm like, those people may be right, but that's not what's driving me. It doesn't necessarily need to be venture scale. Like the founder market fit is the thing that excites me the most. That's the part I have the most conviction about, is that I love the category. Like, sure. Is it going to be hard? Is it viable? Is it like, I don't know. But just as a starting point, I love the category, and there could be interesting possibilities at this intersection. And let me just pull some threads and spend some time in it and see what comes out the other side.
For what it's worth, you sound very similar to some founders that I've worked with prior that I've recently again, or us as a team have backed again, where they had this kind of idea and it was like, I'm interested in this and it sounds cool. And then some of them never come back, but a couple have come back and be like, actually, this could be a really big business. Like I spent after noodling on it for a couple months and investigating. So you may find the same thing. You're doing it for the right reasons, but it actually may be a big business like once you uncover it.
Yeah, and the mistake I made once before is I had a discussion like this with a VC who I'd known a long time and had deep respect for and had never worked with and always wanted to, and he felt the same. And he was like, just take the money. It's an expedition. It's not a company. I get it. And if you don't find anything you like in 6 months, just give it back. And I think the problem there is that what I had was a trend and a wave similar to AI, right? But what I didn't have was the category to anchor in that I loved. And so what ended up happening is I stood up the infrastructure, got the band back together, started experimenting in different areas. But then I had the monkey on my back of having 3 VCs on the cap table, only a little bit of money, and they weren't pressuring me, but it was like, it better look big enough, right? And it messed with me, and then it pushed me down a path of the things that look big enough were things I just didn't care about at all. And then I felt trapped, and then I still have 90% of the money. Yeah. I just gave it back. So if you said, for example, hey, let's go on an expedition, I would say, you know what? Let me go and like really make sure, not just that this is a fun area to experiment, because I know it is, right? And yeah, something awesome might be possible to come out the other side, but let me make sure that the thing that is possible that might come out the other side is the thing that I'm obsessed with and will ride the ups and downs over the next decade plus. And that's the part I'm just like, I don't want another false start. So, yeah.
No, I mean, 99% of people don't realize that, but having done it before, it's good that you do it, and totally agree with all that.
The benefit or the curse of age is that you know where all the bodies are buried. So
Totally.
Hadley, thank you for coming on. This was awesome. I really enjoyed it. I'm glad to now have a dialogue with you. I will keep you posted on my sports idea.
Please do.
And yeah, what you're doing is great and wish you every success.
Thank you so much for having me. This has been awesome. See ya.
Thank you for tuning in to The Next. If you enjoyed it, you can subscribe from your favorite podcast player. In addition to the podcast, which typically publishes weekly, there's also a weekly newsletter on Substack at thenextnext.substack.com. That's essentially for weekly accountability of the ground I'm covering, areas I'm tackling next, and where I could use some help as well. And it's a great area to foster discussion and dialogue around the topics that we cover on the show. Thanks for tuning in. See you next week.